Professor Namyong Lee's commentary, long. The moment PF distorts the FX rate, a currency crisis begins at home. PF is not a real estate issue, but a stress test of the nation's external safety net. Real estate PF, project finance, is not merely a profit and loss matter for construction firms. It is a financial system event that propagates through the credit costs of the financial sector and can spill over into the exchange rate and foreign currency liquidity. Losses from PF do not end as losses on KRW-denominated assets. They amplify USD demand through higher foreign currency funding costs and risk-off behavior, simultaneously shaking market rates and credit spreads. A currency crisis does not erupt because foreign currency is naturally insufficient, but because those who used to lend suddenly stop lending. As PF distress intensifies, the risk premium on domestic financial institutions rises, and that premium converts into higher rollover costs for foreign currency borrowing. The FX market is a fusion of psychology and numbers, and PF is a key input that destabilizes that psychology. It is crucial to recognize the linkage to local government finance and the power embedded in daily life administration. The 2025 budget GUMO for local governments is presented as KRW 326 trillion, and the execution of urban development, permits and approvals, housing, transportation, and welfare largely occurs on the ground at the local level. When PF shakes, local revenues and expenditures and the soundness of regional finance are hit at the same time, opening a channel through which region-originated risk transforms into nationwide foreign currency risk. Numbers reveal PF's current position and its tail risk. As of end September 2025, the outstanding balance of real estate PF loans in the financial sector is presented as KRW 116.4 trillion, with a delinquency rate of 4.24%. New origination at the same point is presented as KRW 20.6 trillion per quarter, prompting claims of a soft landing. Yet the essence of risk is not the average but the tail of the distribution. The tail is already sending warnings. As of end September 2025, the outstanding balance of land collateral loans in mutual finance is presented as KRW 12.4 trillion, with a delinquency rate of 32.43%, numerically identifying where the fragile segment of Landbridge main PF sits. Structurally, PF breaks first in junior tranches rather than senior, before completion rather than after, and in bridge financing rather than main PF, and those fragments spread across the broader financial system. PF may look modest if one stares only at the loan balance, but it grows substantially when viewed as exposure. As of end September 2025, real estate PF exposure is presented as KRW 177.9 trillion. Within that, the watch list, C and substandard and below D segment is presented as KRW 18.2 trillion or 10.2%. Losses emerge not from the balance number but from exposure, and losses then flow through credit costs to pressure capital and credit ratings. There is a four-stage transmission path through which PF distress can evolve into a currency crisis. The first stage is deterioration in KRW credit quality. PF distress appears as larger loan loss provisions, and larger provisions erode both earnings and capital. PF-related provisions and reserves are described as having accumulated to about KRW 11.8 trillion, and the provision coverage ratio for PF loans is described as 64.6%. These figures signal resilience, but also mean that substantial costs have already been paid. The second stage is tightening in funding structure. As credit costs rise, market-based funding rates move first. The deeper the PF losses, the more bank bond, CP, ABCP, and corporate bond spreads widen. Funding disruptions tend to hit non-banks, such as securities firms, capital companies, and savings banks first, and the flame then transmits into liquidity pressure for the banking sector. At this point, there is a zone where a KRW liquidity issue can convert into a foreign currency liquidity stress. The third stage is a non-linear reaction in the exchange rate. Investors and depositors often respond more to direction than to point estimates. As PF distress deepens, CDS, credit default swap, levels and foreign currency funding spreads move, and foreign capital shifts out of equities and bonds toward markets with lower hedging costs. Because the FX market is a market of expectations, once it begins to shake, hedging demand can amplify USD demand in a self-reinforcing loop. The fourth stage is the consumption of the national firewall. FX reserves as of end November 2025 are presented as USD $430.66 billion. As of NQ3 2025, external debt is presented as USD $738.1 billion, with short-term external debt presented as USD $161.6 billion. Indicators such as the short-term total external debt share of 22.7% and the short-term external debt FX reserves ratio of 40.7% are also presented. On paper, a firewall exists. Yet if PF erodes trust in the financial system, there can be a zone where the market becomes uneasy, even with reserves on hand. Bank by bank PF conditions should be read through real estate exposure rather than PF alone. In general, banks hold less direct PF than non-banks. Risk instead appears through real estate industry lending, project-related corporate credit, and PF-linked securitization exposure. Reports present the 5 largest banks' real estate industry lending as KRW 229.8176 trillion as of end June 2025, and there are also cases where a specific bank's real estate industry lending is presented in the KRW 60 trillion range. This indicates that what is large is not only PF, but the size of credit that is structurally sensitive to the real estate cycle. Soundness indicators are leading indicators of external risk stress. As of end September 2025, KB Kookmin Bank's NPL ratio is presented as 0.35% and its loan loss reserves to NPLs are presented as 174.0%. As of Q3 2025, Shinhan Bank's NPL ratio is presented as 0.3%. Hana Bank's NPL ratio is presented as 0.35% and its NPL coverage as 136.0%. Woori Bank's NPL ratio is presented as 0.31% and its NPL coverage as 180.9%. These figures do not imply that banks are in immediate danger. They imply that differences in loss absorption capacity change the speed at which PF shocks propagate. Portfolio sensitivity must be assessed together. In cases where the share of real estate and leasing within SME lending is presented as 31%, the same NPL ratio can still produce different shock dynamics because the portfolio's underlying sensitivity differs. When PF shakes, the first signal to the FX market tends to come not from the biggest institution by size, but from the institution with higher real estate sensitivity. The ranking of the most vulnerable banks should be determined by concentration, not by size. Risk is a combination, not a single number. The share of real estate sensitive credit, the size of PF-linked securitization exposure, the weight of junior and bridge financing, sensitivity to regional unsold inventory, dependence on market funding, and the room in provisioning coverage together form risk. Therefore, it is more empirical to describe which structures shake first under stress than to assert a rigid name-by-name ranking. The first axis to wobble is the segment connected to industries where delinquency shows up earliest in high-risk areas, such as land and bridge financing. A land collateral delinquency rate of 32.43% is a warning that if that segment breaks, banks may not be safe through indirect channels. The second axis is the funding structure. Institutions with heavier reliance on market funding or financial groups whose non-bank subsidiaries, securities firms and capital companies carry larger PF exposure can become amplifiers of external stress. Authorities describe a direction of raising the PF capital ratio from 15% in 2025 to 20% in 2030, explaining the need to thicken equity capital. The third axis is the gap in loss absorption capacity. Even if the banking sector's NPL ratios remain around the 0.3% range, Differences in coverage and portfolio sensitivity can change the pace at which PF shocks erode earnings, and that pace shapes market trust. Currency crisis psychology responds more to trends than to static numbers, and trends are built by the accumulation of small differences. Benchmarking the United States means cutting CRE, commercial real estate risk, with rules before it turns into a monetary crisis. The US manages risk not under the term PF, but through commercial real estate and construction, land development lending, even at the scale where, as of Q2 2025, the stock of commercial and multifamily mortgage debt is presented as USD 4.88 trillion, and banks' CRE holdings are presented as USD 1.83 trillion. The system holds because rules exist. The essence of the US approach is stress testing and early recognition. It pre-calculates how losses under shock scenarios impair capital ratios and liquidity metrics, adjusts loan structures and collateral assumptions in vulnerable segments, and grows only within what capital and liquidity can absorb. It is an operating philosophy of cutting off structures that can generate losses before losses materialize. The lesson for Korea is straightforward. Because the path from PF to external stress runs through funding and psychology, policies to reduce PF risk must be paired with liquidity devices that prevent a sudden freeze in market-based funding and with standardized disclosure that lifts transparency. Benchmarking Germany means absorbing shocks through capital buffers and supervisory indicators. Germany places supervisory indicators at the front based on experience with prolonged real estate price adjustments. The NPL ratio of German banks' commercial real estate loan portfolios is presented as having risen to 4.47% as of Q3 2024. The depth of price adjustment is also numerically visible. German commercial real estate prices are presented as falling 5.4% in 2024 and 10.2% in 2023. When prices turn, supervisors adjust loss absorption capacity through capital regulation rather than moral persuasion. The key point of Germany's approach is the acceleration and deceleration of buffers. A cited example is lowering a capital buffer related to mortgage lending from 2% to 1%, releasing roughly EUR 2.5 billion of capital. The core is a design in which buffers are built in normal times and adjusted to conditions. Korea's prescription is disclosure, automatic braking, and a foreign currency liquidity firewall. First, PF data must be disclosed not as industry averages, but as the distribution of risk segments. Total figures such as PF loan balances of KRW 116.4 trillion and a delinquency rate of 4.24% are only starting points. One must go down to how PF exposure of KRW 177.9 trillion and the watch list in substandard and below segment of KRW 18.2 trillion are composed by region, stage, collateral type, and junior structure for empirical verification. Second, automatic braking mechanisms must be embedded. If indicators such as land-collateral delinquency, bridge share, unsold inventory, watch list substandard shares, ABCP, asset-backed commercial paper, rollover rates, and funding spreads exceed thresholds, rules must automatically reduce new PF origination and junior tranche weight. The market believes not "we will announce measures," but it automatically slows when thresholds are crossed. Third, the FX firewall must be checked by numbers and shared with the market. Firewall figures such as FX reserves of USD 430.66 billion, external debt of USD 738.1 billion, and short-term external debt of USD 161.6 billion must be connected to PF shock scenarios to disclose how much is consumed under which shock. Fourth, bank-level risk assessment should be institutionalized not as name ranking but as comparison under common metrics. If banks disclose under the same definitions the share of real estate-sensitive credit, PF-linked exposure to equity, NPL ratios, coverage, funding structure, and regional diversification, the market prices risk earlier and supervision becomes faster. PF distress can either become a cause of a currency crisis or a training ground that prevents one. PF should not be treated as real estate news, but as a process in which KRW credit is translated into foreign currency trust. When numbers are rebuilt, the firewall strengthens. When numbers are blurred, anxiety appears in the exchange rate. Citizens must awaken. Only then can survival be secured. Thank you for watching Professor Namyong Lee's commentary, Long.